Hi, welcome to Valuation Skeptic. In the last video, we looked at accounts payables and how it impacts financial statements. In this video, we'll look how deferred revenue impacts the three financial statements. It is actually occurs when income is received by a company before it has actually earned it. Typically, when a company receives payments for goods or services that have not yet been delivered or performed. Let's take an example. When you are subscribing to a magazine for a year, 3 years, or 5 years, you are paying that magazine in advance. That is a liability for the company till the time you have subscription timeline. So, for the time being, the company will recognize that revenue in balance sheet as a liability until the recognition of that revenue. Then, as the company serves the customer time by time, quarter by quarter, year by year, the number will fluctuate between income statement, balance sheet, and cash flow statement. To show you the practical example of how deferred revenue impacts, I have right now opened Electronic Arts, a gaming company that is a publisher, developer, as well as distributor of one of the famous game, uh, for football. So how the business model evolves is when a company announces that they are going to publish a game, let's say after a year, they start taking money in advance from the customer for various reasons. If you pay in advance, then you will be getting extra freebies. So that a year in advance revenue is shown as part of deferred net revenue. And as we can see, the company is applying that as a key performance indicators as net bookings. In terms of forecasting the revenue, analysts derive total net revenue with the help of deferred net revenue. As the company delivers the service or when the game is actually launched, the deferred revenue is recognized on the income statement and it will increase, which is also lead to increase in net income. And cash flow balances as per the change in balance sheet. So let's say we have deferred revenue of 200. Just to repeat, why deferred revenue is a liability? We have received money in advance. That is, we have received the cash upfront and the time is not there yet that we have served. So this will be the initial impact of deferred revenue. As you can see, we have matched our balance sheet and cash flow. This is the initial impact. The second impact will come into the picture when as time passes by. For example, when we are recognizing the revenue, this amount of getting recognized will be added to income statement. I'll remove that 50 from deferred revenue of liabilities, and as we can see, previously it was 200, it is now 150. Make sure that we are linking liabilities in the right manner, and this is how balance sheet balances. In conclusion, deferred revenue has a temporary impact on a company's financial statements as it is recognized over time, and it is important for investors and analysts to consider deferred revenue when analyzing a company's financial health and performance. Thank you for watching this video. Stay tuned for more.